Well, to talk about expectations from the budget and what exactly is in store from the Finance Minister on Saturday when she will get up on the floor of the Parliament and present the first budget of the year and the decade. To discuss all that and much more about markets, valuations and the current earnings season, I'm joined by Ridham Desai of Morgan Stanley. Ridham, fantastic to have you back. Thank you for joining us. Ridham, I know you've maintained that budget is an event. We should not focus on it too much. But as members of press, we always like to focus on budget, especially when the budget is 2 days away. So what are the words do you think this time we are likely to use post the budget? Another budget, bing bang, excitement or disappointment?
So Nikunj, the budget generates more TRP than economic momentum. At least that's what I have observed over the years. I mean, after the 91 and 92 budget, incrementally, there have not been such major policy documents. Policy is a all the year round affair. So it's not concentrated on a single day, on a single morning of the budget. Nevertheless, the market focuses a lot on it. At least it seems so. But when you look at stock market performance of the last, say, 25 years, the impact of the budget is waning. Both in terms of the volatility it generates, so for day traders, as well as of the lasting impact it generates on share prices. So, with that backdrop in mind, clearly there are expectations that the government will use this platform on Saturday to continue with, the recent momentum we have seen on the policy front, which, started in, say, August last year. Therefore, I think there is some expectation around it. So what can happen? Well, firstly, I think the most important thing is what is the fiscal target. But even more important than that is how credible the numbers are. And that, this has been all over the place over the past several years. Successive governments have intended to consolidate the fisc. And clearly we have struggled a bit on this front. The targets have been missed. And we have delayed the consolidation. Now, we're looking at 3% over the next couple of years. I think this year may not be that year we get there. Clearly, the trailing 12 months, there is going to be some slippage because of the tax cuts and because of the overall slowdown in the economy. So I think from there, maybe we get some consolidation, but I don't expect a whole lot. The second is, what the government does with its expenditure. I clearly see the need to boost consumption or boost economic activity. So I'm hoping that there is increase in transfers to farmers. The government has a very good scheme in place where it is transferring cash to farmers, which was launched in December of 2018, or rather in February 2018 with February 2019 with retrospective effect from December 2018. I hope that scheme is enhanced because clearly there's pain in the rural sector and this is a direct way of addressing it. Of course, the government has already talked about boosting infrastructure spending, so we'll wait for some more details in the budget. Then the second thing is what it does with taxes. There's clearly room to rationalize taxes, and I'm hoping again, I don't know if I can say I'm expecting this, but I'm hoping that there is attention paid to capital markets. Whether it's dividend distribution tax, whether it's long-term capital gains tax, I think there's scope for us to rationalize these, and this may be a good year to do that with that direct implications on share prices and, of course, the economy. Because remember, share prices reflexively act on the economy as well as the other way around. So it's not just the economy that influences share prices, but even share prices influence the economy. And maybe the third area that we should be looking at is, how the government wants to tackle, monetizing its balance sheet, what we call as privatization. Because clearly resources are constrained with the current economic backdrop, and therefore there is greater monetization of the balance sheet needed. I think they should get really aggressive about this. 2001 to 2003 is a good template to use when the erstwhile NDA government under the leadership of Vajpayee and Arun Shourie had launched a massive privatization program. So I think that's the type of privatization program I'm hoping gets launched for the next 12 to 24 months.
Now the country is getting a detox because of the other reforms which have happened outside budget. But right now the economy needs a caffeine shot, which means more money should reach the consumers. What could be that caffeine shot in this budget?
So see, I think Nikunj, it's not about providing caffeine shots because those, fade away very quickly. What I think you need is greater focus on structural reform. And there's a lot of low-hanging fruit on that front. And it's not the budget that, is the platform for doing this. I mean, you can make the announcements there, but really the action has to happen on a daily basis. So whether it is, liberalizing the investment environment, whether it is making investments more viable, whether it is actually getting manufacturing companies to start setting up capacities, those are the things I think that will actually revive the economy on a more sustainable basis. Yes, you can throw some money around and hope that people will spend it, but that's not actually going to create a sustainable recovery in the economy. What we can also wish for, and I think that's the Morgan Stanley view, is that there will be a modest improvement in global growth. Of course, there is this virus risk out there, and I hope that it fades away. And we have to keep a great vigilance about it because it has the potential to spoil what has been a nascent economic recovery. And people underestimate the role of exports. We've been talking about this for a while. India's share in global exports has been stagnating for the last 6 or 7 years. On a physical plus services number, it is about 2%, and that needs to go up. Because if you want greater economic prosperity, you need to trade with richer people. If poor people are trading amongst themselves, that is, if we remain a domestic economy, we're not going to actually create prosperity. So it's very imperative that we go out and trade with the rest of the world. So you need trade deals out there. You need a trade deal with the US done, with Eurozone done. So I think these are things which are outside the budget, which are far more sustainable in creating economic growth and prosperity than single cash shots thrown at consumers. Also, don't forget, come August, there's a massive refund that's coming the way of the middle class, which was announced again in the February 2019 budget. I think if I remember correctly, it's about 20,000 crores, which will come in the form of refunds to middle-class taxpayers. So there is already that pending stimulus that is coming in August. So I think there's more need to do structural reform. The terms of trade in this country are transferring the wrong way, which is that it is going from the farmer to the middle class or the upper classes in terms of income. That's what I mean by classes. Whereas it should actually be going the other way, which is that richer people should be transferring terms of trade to farmers. So now how do you reverse that? You can't lift food prices because food prices then create generalized inflation and everybody suffers. So I think the best way to do it is through these cash transfers. And it is now possible because the infrastructure is in place due to Aadhaar and DBT. So I would only focus on that segment for throwing cash, but not general consumption. I think you rather work on structural reform and save your bullets for those rather than spend your money away. And therefore, infrastructure is a much better area to spend and create jobs than to just throw cash into the consumer's pocket.
So my next question, Ridham, is about what markets thought the bent of the government was. When tax on buyback was introduced and when surcharge on super rich came through, the sense which a lot of us, including members of press and investors, got that is this government anti-rich? Is this government against wealth creator? So do you think more than anything else, it's the attitude and the whole tonality of the budget in terms of what the vision is will matter? Because that's the last thing which you want the budget to project, that they want to tax the wealth creators more.
No, fair enough, Nikunj, and I think the buyback tax was only to close the gap, the arbitrage which was available because of dividend distribution tax. So now if you take a relook at dividend distribution tax, and if that is removed and dividend is then taxed in the hands of the recipient, which necessarily does not lower tax burden. In fact, if anything, I think the tax burden goes up depending on the details. Then the buyback tax has lost its meaning, and therefore it will also be removed, logically speaking. So I think the buyback tax should not be viewed as an anti-rich measure, as it's being talked about. I think that was only to close arbitrage that was there. If you go back years ago, the government had introduced DDT on debt funds. That wasn't done initially when first time dividend distribution tax was brought in, and it was done later on because people realized in the government that there was an arbitrage between bank fixed deposits and debt funds which was hurting bank fixed deposits. So I think, that was the reason for the buyback tax. I mean, the surcharge on the super rich, and we discussed it last year as well. I think, very clearly the finance minister said last year it's not a permanent move, it's a temporary move because of the shortfall in resources. So again, I think if that it remains a temporary move, and if it's reconsidered in whatever time frame that they are suggesting, then it will get reversed, right? So, I buy your point that you want to actually be subservient or paying attention to the entrepreneur, because the entrepreneur is the one that's taking risk and creating jobs, and I think he's the most important, or he or she is the most important person in economic prosperity. And I hope that, that gets its due attention. We've heard this from the Prime Minister as well. And we've seen the actions of the past few months. I think the entrepreneur is back. He's back in consideration. So I think that spirit should be expected from the budget, and I'm expecting that to continue.
For FY21, what do you think should be a reasonable tax or a revenue assumption?
So again, I think obviously this year is hurt because there was a very big change on corporate taxes in terms of rates. But GST revenues are actually picking up and finally stabilizing and looking like they are going to be over the six-figure mark now on a sustainable basis. So that, I think, is a good indicator. And Nikunj, I'm just stepping back for a moment. If you look at high-frequency data, a lot of them seem to have put in a bottom in the October to December timeframe. And are all turning up, including industrial production, which hit an all-time low in October and is now coming back from there. Now, I'm not saying that the economy is firing on all cylinders, of course not, but it does look like the economy is bottoming out. And to that extent, I think we can hope that nominal growth next year is a whole lot better than it was this year. So maybe this year nominal growth is in the 8 handle, and next year the nominal growth is in the handle of 9 or approaching 10. And that should be the basis for computing taxes with no changes in rates. So I don't think there's any dramatic rate change coming after what has already happened to corporate taxes. So I think 10% is a reasonable assumption for nominal growth and therefore tax collections, in my view. Again, this is on the presumption that there are no changes in rates. If there are changes in rates, then accordingly that number changes.
Over the years, more and more services have reached the tax bracket. 10 years ago, going to a gym or going to a beauty parlor was not taxed, but today it is taxed. Given that the economy is changing, we are becoming cashless, we are moving towards digital, do you think more and more services, especially 1 or 2 new services from the digital economy, which could be included as tax bracket, which currently are not included?
So Nikunj, that won't be a subject of debate on Saturday, because all indirect taxes are now, the prerogative of the GST committee, and therefore I don't expect anything, in that regard on Saturday. The GST committee will look at all these things, and I think over time there will not be a single service or good which will be outside the purview of taxation, whatever the tax rate is. I think we are heading into, over time, again, say next 3 to 5 years, where the number of tax slabs reduce to maybe 2 or 3, and the tax burden in terms of the rate actually declines. And that will be a consequence of greater compliance that I think we will achieve over the next 3 to 4 years. So that will be the overall trend in this. More and more services will be included and goods will be included, and I think the overall tax rate will go down.
Difference between personal tax and corporate tax is very large now. I don't want to use the word arbitrage here because it is not an arbitrage, but again there is a scope for tax leakage there. So looking at the fact that they moved already on corporate tax, do you think changes on personal tax are coming for sure?
So Nikunj, it is an arbitrage because there are a lot of firms in India that are organized as proprietary or partnership basis, and their tax rate now is a lot higher than a corporate tax rate. Now, hitherto, a lot of firms, small firms, I'm talking about really small firms like the Thela wala sitting outside our building, would not set up a corporate entity. If he or she is paying taxes, would prefer to keep it as a proprietary or a partnership firm, because there are there's a pretty long list of compliance that you need to fulfill as a corporate entity. So the minute you do that, you are getting into higher costs. But the arbitrage now is significant for a lot of people to reconsider the structure under which they want to operate their businesses. And I expect a lot of small and micro enterprises which were not operating as corporate entities to look to actually become corporate entities. And to me, actually, this is a very big formalization move. In fact, this is bigger than what DMON or GST achieved. The tax arbitrage between a regular firm, a non-corporate firm versus a corporate firm is pretty large enough for people to think that, let's become corporate entities. So I think actually, I'm sticking my neck out, but over the next 12 to 18 months, it's quite possible that corporate tax revenues surprise on the upside because compliance levels go up, because people become more formalized in their structures due to the tax arbitrage. And I don't know how long that sustains, but it's unlikely that personal tax rates drop to the corporate level in any foreseeable future. So there will be this arbitrage that will continue, especially at the highest end of the tax bracket.
Do you think LTCG, which in a sense was imposed at a different time when the narrative was that elections were near and the government was criticized for having this corporate image of Sood Boot Ki Sarkar, that tax is the lowest hanging fruit which they need to plug, because bringing back LTCG frankly has not given them anything beneficial on the tax front?
So Nikunj, I have a pretty strong view on this, which is that long-term capital gains tax is not justifiable from an economic perspective, because capital gains is notional income. It does not actually add to the overall output of the economy, and therefore it should not be taxed. Another argument that I would make against long-term capital gains tax is that long-term capital gains is nothing but future dividends. And in any case, the dividend income is taxed. So in a way, it is actually double taxation. So on both counts, I think long-term capital gains tax for a growing economy like India is not justifiable. We can't compare ourselves with developed economies where the per capita income is $30,000-$40,000. We need a vibrant capital market. We need people to take risk and invest in equities and create more risk capital, because that's the way we'll create more jobs. So I think there's a very strong case to simplify all of this, and therefore I hope that it's done in this budget or in the foreseeable future. So let's see what happens. But I have a pretty strong view that long-term capital gains tax should not be there in India until India becomes more prosperous and has a much higher income level than it has today.
Ridham, you've argued in the past that the only way the government should move is that they should become asset light, which is disinvestment. A, there is need, B, there is desire. But need and desire sometimes do not translate into reality. Given that where markets are and given that disinvestment is a very complicated process, because you are looking at selling government ownership. So what is your sense there? Any fat number on disinvestment should be taken with a pinch of salt. The intention may not be there, but the delivery may not happen because of X, Y, or even Z reason.
So Nikunj, I don't like to use the word disinvestment because it conveys the meaning that we're going to sell small stakes to institutional investors, mainly LIC. I think we should use the word privatization, which has a very different connotation to it. It is actually selling the government stake lock, stock and barrel, but more importantly, transferring management control. I think the second thing is far more important than just the sale of the stake. And I think the time is ripe for this. I think there's been a change in the opinion of the government. We've seen that they've put up few entities for privatization, not disinvestment, which is they are selling controlling stake to new management. And this is not a new experiment for India. The template is already available. We have done it very successfully in the past. If I remember correctly, the Vajpayee government had sold 36 companies, lock, stock and barrel. Therefore, I think that same template can be adopted. I think there's enough demand for Indian assets if the process is laid down properly. which I don't think is beyond the capacity of this government. I think it's pretty much well within the reach, given that there is a shift in thinking about this. There's both a need and a desire now to do it, so it can be done. I don't see much impediment here. I'm actually hoping that we really go for really a big scaled up privatization program for the next 12 to 24 or even 36 months.
I'm going to navigate away from the budget rhythm and talk about the current trends, what we are seeing. High frequency data points are looking up. Not all of them are bright, but yeah, there are sparks available now. But what is happening, Ridham, is that the big companies are becoming bigger. What is like a global mega trend? Bajaj Finance has done well, others are suffering. Asian Paints has done well, others are suffering. HUL is growing, but others are not growing. What do you think this means for investor? Because the big are getting bigger. I wonder what will happen to the rest of the economy and mid and small cap stocks.
So Nikunj, there are two parts to this. I think it's a very good question you've asked. There are two parts to this answer. There's what happens in the short run, which is say the next 12 to 24 months, and what happens over the next 3 to 5 years, because the answers are different for these two time frames. I think for the next 12 to 24 months, there is a mean reversion that I'm expecting, which is already underway, which is a lot of small businesses have become dramatically undervalued and underowned. And I think they will also experience much faster earnings growth if the economy recovers like we are expecting. So to an investor, I think that's where the low-hanging fruit is. For anybody with a 1 or 2 year view, that's where you want to have your portfolio. Rather than the trailing winners, a lot of those stocks have become quite rich in terms of valuations. They will continue to grow earnings, but probably not at the same pace as smaller firms may achieve in the next 1 or 2 years. Again, the caveat, of course, is that the economy recovers, which is the base assumption we are making. If you take a slightly longer term view, there is a case for these large caps to continue to do well, because the share of passive money in globally managed money is rising. It's also rising in India, and passive money tends to go to index stocks and therefore tends to favor large cap stocks. And this is a virtuous cycle for large cap stocks, or a vicious cycle against small cap, however you want to put it, which is that the money flow gravitates to a small number of stocks. And then ultimately when the passive money becomes too large, then the arbitrage will move away, and then that medium-term trend will break. So I think you keep that aside for now, because that's a little bit too in the distant future. I think focus on the 1 or 2 year call, which is that there's undervaluation, under ownership, and likely acceleration in growth in the small and medium cap stocks, and that's where I think investors should pay attention if they want to generate alpha versus the index, and that should be pretty easy, save for a global recession or something that goes wrong in economic conditions globally.
Ridham, last time when we met, we spoke about mega trends. You spoke about inflation being low. You spoke about electric vehicles being a reality. So I'm going to twist this time and talk about the high earnings sector for next couple of years. Every sector will see some domination. Last couple of years, it's been consumers and private banks. So if you have to really mark out 2 or 3 large pockets which could be called as high earnings sector for the decade, where would you like to point out?
Yeah, so I think, Nikunj, we'll probably highlight 2 sectors there. I think industrials looks like they are coming out of the woods. We've seen a big drawdown in capital spending. Corporate capex is now gone down to around 5.5% of GDP. It peaked at 17 in 2010. That 17 came from a number of 4% in 2002. So from 4 we went to 17, from 17 we've gone down all the way to 5.5. I think it may turn, and in the next 3 years I think this number should be higher, and therefore industrials I think should do well. There's also a backdrop of higher government spending on infrastructure, which again benefits industrials. So that's one pocket, and I think the stocks there look interesting because even the valuations look quite okay, and a lot of balance sheet restructuring has also happened. So that's one space. The other space is discretionary consumption. I think as the economy recovers, income levels recover, jobs come back, a lot of discretionary consumption should also return. So I'll differentiate that with staple consumption. which has not really slowed down except for the last couple of quarters, and that may also stage some recovery. But discretionary, like autos, auto ancillaries, travel, leisure, I think these things have more upside as consumption improves and as income levels improve. So maybe these are the two places where we should see better than average earnings growth.
Ridham, always fantastic to connect with you. We started with the budget, we covered a range of topics, so always look forward to interaction. Thank you for joining us and have a wonderful day ahead.
Thank you.